How do you record journal entries? What is the process? We're going to review the accounting cycle real quickly. Now remember, the accounting cycle starts with analyzing the data. You analyze the data for several reasons. One, you want to make certain that you understand exactly what has occurred, and you want to ask yourself the question, has the earnings process been complete? Have we incurred an expense? And also describe the transaction or the flow of cash. So once we are able to identify those types of issues, we can determine whether or not we record an entry and how to record that entry. Number two, we want to journalize it. Journalize is just actually recording of that transaction. We want to recognize an event has occurred. Number two, once we record the entry or we journalize the entry, we want to post them to our general ledger. And again, we are using an Excel spreadsheet to do this, but it's simply the same thing in an accounting system. We want to record these entries in a general entry, and we record them in a double-sided entry, meaning our assets will always equal, or our debits will always equal our credits. So we want to record them. Once we record all of our entries, we want to prepare an unadjusted trial balance. Now, unadjusted trial balance is simply of a listing of accounts and their ending balances in debit credit format. And remember, our trial balance have to balance. The debits have to equal the credits. Once we achieve that goal, we want to record adjusting entries. And adjusting entries is for the sole purpose of getting the certain accounts correct with their ending balances. We want to recognize our accruals at that point. We want to recognize the use of our assets at that point. Once we record our adjusting entries, we want to prepare our adjusted trial balance. The adjusted trial balance is for the purpose of allowing us to prepare financial statements, and we will be doing that, quite frankly, in the next step. Once we record once we prepare our adjusted trial balance, our financial statements will be able to be prepared. And then once we have our financial statements done, we are complete, so to speak. We then want to record our closing entries. Our closing entries are going to reverse or close or zero out all of our temporary accounts. And which we discussed before, our closing entries are going to close our income account, our expense account, and our temporary dividend account. Once we close those accounts, we prepare our closing trial balance. The closing trial balance will have only permanent accounts. So on that particular report, all you will see is the assets, liabilities, and equity. Our revenues and expenses will not be seen on that. And then we record our closing or our reversing entries. Once we've done that, we start the cycle all over again. Now, what I would like to take a few minutes to talk about, which gives students such a big problem, is when we record transactions, how do we know to debit something? How do we know to credit something? And the answer is in this little worksheet. We want to categorize our transactions by the asset, liability, or equity. Now, when we think about that, we think if I have a transaction and I'm recording the sale of my inventory, and I'm letting people know that I'm recording the sale, but I'm not getting cash. You can identify two accounts already. One is revenue and one is a receivable. Now, where does revenue fit in the scheme of things? Is revenue an asset? Is it a liability? Or is it equity? Well, revenue is an equity. So we know we're going to increase our revenue. So if we're going to increase our revenue or equity, we know we're going to credit it. And we already know that our accounts receivable is an asset. If we know accounts receivable is an asset and we're increasing it, we know that for assets, we have to debit it. So now we know we're going to debit our receivable and we're going to credit our revenue. That kind of gives you an idea of how to record transactions and also how to think about the transactions so that you know when I'm going to record this transaction, I know that I have an asset in this transaction and my asset is going down. Oh, I need to credit it. So use this particular little spreadsheet here. I wouldn't call it a spreadsheet, but it's a little diagram to help you think about your transactions a little bit more critically and be better able to determine if an asset or a liability or equity in your particular transaction requires a debit or a credit. Now, here I'm using the asset equal liability plus equity to help you journalize. And it's not always the easiest way, but it's one way that you can look at it. So when we track our transactions, we have to remember our transactions have to equal. We can't have an out of balance transaction. So our debits and our credits have to equal. So this is just giving you an idea how we can record a transaction in the format of an asset equal liability plus equity. Now, remember, we can record a transaction in that format. The most important thing when we're recording transactions, are we recording them in the proper way? Are we using good form? Does the transaction have a debits equals to credits? Are we increasing our accounts appropriately? Are we decreasing our accounts appropriately? Meaning, if we're decreasing an asset, we shouldn't be debiting it. We should credit that. If we're increasing our income, which is an equity account, are we crediting it? That is a number one question. So debits have to equal credits. We have a double-sided entry or double entry accounting. We have to make certain that our accounts are being increased and decreased appropriately, and we're following the structure. Meaning, if our assets are going up, we debit it. If our assets are going down, we credit it. If our liability is going up, means we have to pay some money later on, we're going to credit it. If we're paying back our liability, we're going to debit it, and so forth. Now, adjusting process. Remember, there are transactions that we have to show that we have incurred. We have made use of an asset. Using an asset means you have to incur an expense. Depreciation is one transaction that we show the use of assets, long-lived assets in particular. Unearned revenue. If we've earned the revenue, we have to remove that obligation of unearned off our books. That means we have to recognize revenue. If we have used the rent or insurance, we have to show the use of it. Showing the use of rent or of insurance is an expense. We have to show that we've earned revenue, but we have not recorded that. So the accrued revenue. We have to show that we've incurred or made use of an asset, but we haven't paid or recorded it. That's an accrued expense. And those are the typical transactions that you'll have to record during the adjusting process. This is what adjusting an unadjusted trial balance would look like. Remember, take note here at the bottom. I know that it says 215.76, and this didn't show the 4, but these two actually balance. I just want to make that clear. So when we record our adjusting entries, we want to recognize expenses that have been incurred but not paid. We want to recognize earning income during the period, but we have that we have not billed or recorded. Important. We want to record expenses that were paid or incurred but not recorded on our books, and that's very important. So recording depreciation, again, this is using the straight line method. All it is just taking your cost minus your salvage value divided by the life gives you the annual depreciation. Now remember, we want annual depreciation, but you might want to record only a few months. So that annual depreciation number of $20,000 may have to be prorated for the number of periods that we are covering in that financial statements. Very important to note. And here is the entry that you'll record. Now, the use of supplies. If you have supplies of $20,000, but at the end of the year, only $500 remain, you have to show how much you've used. The difference between what you purchased and what's left over is your adjustment. And here is the entry. We're going to reduce our asset of $19,500, and we're going to show how much we've used, which is the expense of $19,500. Again, earned income. Remember, we recorded a transaction. We didn't record this transaction. We've actually completed a job for a client, but we haven't billed them for it, and we haven't recorded it. But we still, based on GAAP, have to record that transaction. So we're going to say at some point we're going to expect money from this client, a receivable, and we're going to expect to have that money collected in the near future. So we have to show a receivable of $50,000 and recognize the revenue of $50,000. Now, there are times when you have to record, there are fees or charges that you have incurred but have not been recorded. These are, again, adjusting entries. Not in our paid and approved project, but in reality, you will have bank fees and other types of costs that you will have to record on your on your books based on your reconciliations. So these are another type of adjusting entries that you will have to record prior to recording or preparing your financial statements. And this little diagram is very hard to read, but you'll see on one half, on the left-hand side, you'll see your accounts and your debit and credits in the unadjusted columns. But then you'll see your adjusting entries. Then you'll see on the other side the total, which is your debits netted with your debits or subtracting your credits to come up with your new ending balances. When you look at the bottoms on the left, on the right hand side, you'll see your debit and credit columns will be the numbers that you'll use to prepare your financial statements. And here is a copy or an example of what a balance sheet looks like. Remember, your assets of $153,700 have to be the equivalent of both your equity and your liabilities. Very, very important for good form in your balance sheet. And here is a copy and a very good idea of what your revenues, your income statement would look like, and your statement of retained earnings. Now, what's important with this particular example is the order by which you prepare this. You have to prepare your income statement first. The income statement gets prepared first, then it'll allow you to be able to prepare your statement of retained earnings, and then, and only then, are you able to prepare your balance sheet in its entirety. So, prepare your income statement first, balance sheet is going to be last. Income statement first, statement of retained earnings second, and then balance sheet. And once you have completed your financial statements, you are then able to close your accounts. And we already showed you what the entries look like, just letting you know you're going to be closing your temporary accounts. And temporary accounts are going to be your income accounts, your expense account, and your dividends accounts. And then you are basically closed. Now, this is just another example of what the closing entries would look like. And here is what a post-closing trial balance would look like. Again, these are very, very important steps, but I think if you look at this video over and over again, it will start to make a little bit more sense. I am very happy that I had opportunity to give you an idea of what's coming up soon, and I hope this video is very helpful to you.